There's been a lot of press about the lack of funding for business. It's generally accepted that this is hampering the recovery. The fact that there's more companies needing financing presents us with the opportunity to build an exciting high growth portfolio, and who knows, possibly investing in the companies of the future. CCS Partners was established in October 2001, and what we were looking to achieve was to enable private investors to invest into private companies. This is an area we know that private investors are interested in, but quite often they lack the information in order to make an informed decision. Venture capital is provision of development funds to private companies. These funds allow companies to perform their business plan and hopefully achieve a listing or a trade sale. Most people look at venture capital in order to increase the growth potential of their portfolio. It's a high risk end of the market. We're invariably looking at small growth companies. But most people recognise that in order to see higher returns, you have to take a higher risk. The returns depend on each individual situation, but because we are taking a higher risk, we are looking for multiple returns. We're looking for small growth companies, so it's important that we identify companies that have good management teams. They also have a good product, something that sets them apart. From there, what they're lacking is funding, and that is where we come in. We do look to take a stake in each business. We're looking for businesses, we do a lot of research to identify businesses that have got high growth potential, and obviously we want to benefit alongside our clients. The companies we're identifying are small companies, and as such they have small management teams, they have limited resources and limited funds. So they have to be considered as high risk. But that's exactly what we're looking for, and that's exactly what our clients are looking for from us. If we can identify companies that have high potential and have a cutting edge in the market, and with sufficient development capital can possibly perform their business plans, then we're looking for companies that the high potential matches the high risk that you're taking. EIS is the Enterprise Investment Scheme, and it was launched by the government to encourage private investment into unquoted companies. There are a number of tax breaks to the EIS, the first of which is income tax relief. In the year of investment, you can claim 30% of what you have invested against income tax. The next major benefit is after 3 years, any gains are free of capital gains tax. This is a great tool to try and maximise returns. In addition, any capital gains you have made 3 years prior to investment or the year after investment can be deferred into an EIS company. Lastly, any losses from these companies can be offset against capital gains tax, which is fairly normal, but most importantly, can be offset against income tax. This is a way that a lot of astute investors look to mitigate tax. In general, with a portfolio, if you can look to maximise returns and manage risk, then that's a pretty good way to go. Many astute investors use the EIS to achieve that. The investment size depends on what you're looking to achieve from this portfolio. A number of people will be looking for much higher growth, in which case they might build a larger percentage into this area of the market. Equally, if you're looking to build a smaller venture capital portfolio, then that's something we can help you achieve too. If your portfolio is geared towards growth, then you should be looking at higher risk end of the market. We would always recommend a maximum of 20% of portfolio in this end of the market. The reasons for that are we think we can achieve high growth with a relatively small part of your portfolio. Everyone's take on what's short and medium and long term is different, but in general, with our investments, you have to take a 3 to 5 year view. The reason for this is quite simple. We're providing development capital for small companies. As such, they have to spend the money and see the fruits of that business plan come through for us to see the kind of capital appreciation we're looking for. Equally, we're looking at small companies and we're looking for high growth. This does take time, and it's important to try and maximise that growth. You will be allocated a broker who will endeavour to keep you up to date with all developments. We'll also ask the company to send out quarterly updates, whereby you're receiving information directly from the companies themselves. Finally, we'll have an annual conference whereby we invite clients to come along and hear the companies actually present. This is a great way for our clients to meet the directors and ask them questions directly. At what point you sell, it really depends on an exit being achieved. First and foremost, we are investing into private companies, so a typical exit will be a listing or a trade sale. Trade sales are straightforward. We're offered a price and you have to decide whether that's a price you're willing to take. Does it achieve the kind of growth you're looking for? In general, with the companies we look at, if they've suddenly become the radar of the large institutions or the large companies, then we'll be looking at a multiple return at that point. Listings can be a little bit more tricky because a listing is a stepping stone, possibly towards a trade sale. In that case, there could be a danger of selling too early. We're investing into high-risk companies. We have to make sure that we're maximising the returns wherever possible. We don't charge any fees to our clients. So if you invest £1, you receive £1's worth of shares. We do charge fees to the companies for actually raising the money for them, but this is back-ended and is performance related. Most importantly, we receive shares in each company and we look to build a stake in each company. This is how we really see our returns. All of the fees run the business. Our real returns hopefully come from the companies. This way, if you gain, then we have the opportunity to do so too. We'll provide the information for you to make an educated decision. Each company, there'll be a high level of research, and from that research and due diligence, we'll produce a placing document which will detail all the risks involved in investing into that company, as well as the potential upside, what the company is looking to achieve, and that way you can go into each investment with your eyes wide open. You'll go into each company understanding what the risks are, what the company is looking to achieve, and if they do perform that business plan, what the potential upside is. If you're interested in building a portfolio in venture capital, it is important that you do read our terms and conditions. We have to make sure that you are suitable to invest into this asset class. From there, we'll look for investment opportunities for you, which we feel will be of interest. You will receive a presentation from the companies, from the directors, so you're hearing what they are looking to achieve and what their business plans are. And also there'll be a brief summary from us, whereby we're pointing out the major pluses and the major minuses. That way, again, we'll look for you to make an informed decision. I hope this has been helpful and that you've got a better understanding of what we're looking to achieve, and hopefully it fits into your investment plans going forward. If you do have any further questions, please do not hesitate to contact us.